The construction industry encompasses a wide range of activities, from one-person subcontractor to major city builders. As diverse as the construction industry is, it is very similar in its accounting policies. The choice of accounting treatment will have a significant impact on your ability to raise financing, obtain bonding, and when and how much taxes you pay. These choices will have a direct impact on your cash flow and thus how you operate your business in an effective and efficient manner. Construction accounting basically is billed and accounted for on a percentage of completion basis. In other words, you will be billing on an ongoing basis as the work progresses. And therefore, you're going to have unique, significant accounting policies such as revenue recognition, work in progress and deferred revenue, property under development, and in this section, land, construction, soft costs and hard costs, timing, when you bill, is it inventory or is it capital gains? And other areas is going to be income taxes, long-term assets, and holdbacks. This is very different, as we said previously, from the manufacturing retail sector because they bill when they sell the product. We recognize revenue when it's earned on a project, not necessarily when it's billed or when the cash is received. And this is a very important criteria. Revenue is recognized as it's earned, not when it's billed or when the cash is received, but when the costs are incurred. For example, if material is purchased along the way and is stored on site, that typically cannot be billed until you actually install it in the ground. But for accounting purposes, it gets recognized as revenue. For long-term contracts, generally recognizing revenue on the basis of costs incurred over the date compared to the total cost of the project. And this is, therefore, estimates are very important when you are looking at a contract. Improper recognition of revenue can lead to poor and misleading financial results and can skew your financial statements. So that leads us right into work in progress and deferred revenue, which is a key component in revenue recognition and in the accounting for construction industry. So what happens? You bill and the contract's not always tied into the cost. I'll give you an example. It might be where you buy product and you ship it to the material to the site, but you cannot bill for it until you actually install it in the ground. That is one of the key variances between your billing and when you recognize revenue. The timing difference between actual billed and revenue earned requires accounting adjustments to be done throughout the year. Overbilled is deferred revenue and underbilled is work in progress, and they are significant. We've seen work in progress of $2 million, $3 million, which significantly changed the financial statements. Deferred revenue would be treated as a liability on the financial statements, and work in progress would be treated as an asset. So, as I said, these are important criteria when you're preparing the financial statements for an accounting for the construction industry at year end. Holdbacks. In Ontario, the Construction Lien Act requires that the payer retain a statutory holdback on all liens until the job has expired. In other words, they get to keep 10% of your revenue. The revenue is recognized, but the owner or the contractor or the subcontractor on a job gets to keep that 10% and does not pay it back until the job is finally completed. Typically, as I mentioned, the holdback is 10% in Ontario, but we've seen situations where it goes up to 15, 17%. There could be warranty holdbacks, there could be holdbacks because of the nature of the jobs. Income taxes, there's two methodologies. There's the completed contract basis of accounting, where the taxes would be paid at the completion of a contract, or there is a percentage of completion basis of accounting where income taxes are paid on an ongoing basis. The two methodologies are quite different, and if you are doing long-term contracts, it may be to your advantage to use the completed contract basis of accounting, because ultimately you don't pay taxes for a year or two down the road on the income earned, and it allows you to have cash flow during that period, which is very important for a construction industry. The choice and method of taxes chosen has a significant impact on the cash flow of a company. Long-term assets. Accounting treatment for real estate must be carefully examined. Long-term, it depends on intended use. Are you going to be using it for rental income and therefore deemed to be a capital asset? Or are you going to be using it to sell it, which is deemed to be inventory? And the accounting treatment for one varies substantially from the other one, and especially at the time of sale of that asset, because if it's a capital asset, it's deemed to get capital gains. If it is inventory, it's basically 100% taxable. And that is a huge difference in the amount of taxes that you are going to pay. Real estate under development. There is a component called soft costs and hard costs. Some soft costs, such as site investigation, ground rent before, during development, financing costs, and general overheads, are deemed to be soft costs and therefore expensed at the time. Whereas hard costs are added to the cost of the project and basically get accumulated until the project is completed and actually sold. There's things such as finance costs, tenant inducements. These are all other items that you have to be aware of. Deferred charges, bonding, banking, WSIB, labor laws, and other financing costs. The industry knowledge and experience is so important in the construction industry. If you do not have industry knowledge, we've seen situations where holdbacks have not been recorded and therefore the construction company basically understated its income by 10%, where it paid GST on holdbacks and it shouldn't have, where it paid taxes on work in progress and it shouldn't have, where it didn't use the completed contract method of accounting for tax purposes and therefore paid taxes 2 years ahead of when it could have. These are all issues that only an experienced accountant can help you with. So make sure when you go look for a company, an accounting firm to assist you with your accounting and your taxes for your firm, that you get an experienced accountant. If not, you will end up doing yourself a major disservice.